Welcome to this explainer. Today, we're exploring something absolutely foundational. I want you to think of global accounting not just as a bunch of spreadsheets and numbers, but as the literal architectural blueprint of global business. You know, just like you can't build a massive skyscraper without a rigorous set of structural codes and physical laws, you really can't build, sustain, or evaluate a modern international corporation without a universal set of financial rules. So today, we are looking at the IFRS conceptual framework, which is essentially the physics of the accounting universe.
I want to pose this question to you right off the bat. How do we universally measure the success of a business? Think about the sheer, mind-boggling complexity of standardizing financial reporting across the globe. You've got a manufacturing plant in Tokyo, a tech startup in Silicon Valley, and a mining operation in Perth. How do you ensure that when an investor looks at their financial statements, they are speaking the exact same economic language?
Okay, let's dive into this and lay out our structural blueprint for today. We'll start with the regulatory blueprint, move on to the golden rules, then the 5 financial elements, and wrap up with presenting the financials.
Section 1. The regulatory blueprint. Before we even look at a single balance sheet, we really have to understand the foundation standard setters use. The rules of accounting don't just magically fall from the sky. As our source notes, having a conceptual framework avoids a firefighting approach and has a proactive approach in determining best policy. Basically, without this unified logic, standard setters would just be running around putting out fires for every new, bizarre financial instrument invented on Wall Street, rather than following a cohesive plan.
And this brilliantly illustrates the massive difference between the two major accounting philosophies in the world. On one side, you have a rules-based system. This is highly descriptive, packed with detailed rules, but honestly, it can actually encourage companies to just look for technical loopholes. On the other side, you have the principles-based system. This relies heavily on a conceptual framework and requires professional judgment to meet key objectives. IFRS is fundamentally a principles-based system, which is why understanding its core concepts is absolutely crucial.
So who actually builds these principles? Well, here's the hierarchy of international standard setting. Step 1 is the IFRS Foundation, which oversees the entire operation, secures the funding, and appoints members. Step 2 is the International Accounting Standards Board, or IASB. They're the real architects here. They develop and publish the actual IFRS standards. And Step 3 is the IFRS Interpretations Committee, or the IFRS IC, which steps in to issue timely guidance when ambiguous accounting issues pop up in the real world.
Now, before these bodies write a single rule, they rely on one vital bedrock assumption, the going concern assumption. This is the premise that a business will actually continue in operation for the foreseeable future, generally defined as greater than 12 months. Every single standard, every valuation, every financial statement is prepared under the assumption that the company isn't about to liquidate tomorrow. If it is, well, the entire blueprint changes.
Section 2. The golden rules.
If the going concern assumption is the concrete foundation, these qualitative characteristics are the building codes. The framework divides these rules into 2 distinct tiers. The absolute non-negotiable fundamental characteristics are relevance and faithful representation. Then, the second tier contains enhancing characteristics, things like comparability, verifiability, timeliness, and understandability. These enhance the data, making it highly useful, but they absolutely cannot save information that is fundamentally irrelevant or false.
Let's look a bit closer at faithful representation. For financial data to faithfully represent economic phenomena, it must be 3 things: complete, free from material error, and neutral. And neutrality is fascinating here because it specifically requires exercising prudence. That means when management is making judgments under conditions of uncertainty, they must exercise caution. They have to make sure assets and income aren't overstated and liabilities aren't understated.
Section 3, the 5 financial elements.
Now, what's really interesting is how we transition from theory to the actual materials used to construct financial statements. First up, the asset. The framework defines an asset very precisely as a present economic resource controlled by the entity as a result of past events. I want you to keep that specific wording in mind because it sets up a major revelation we're about to uncover.
Next up is the liability. This is defined as a present obligation of the entity to transfer an economic resource as a result of past events. And further, an obligation specifically means a duty or responsibility that the entity has no practical ability to avoid.
Okay, here is where the strict wording of the framework totally blows the lid off traditional assumptions. Look at this quote from our source. Ownership is not mentioned anywhere in the definition of assets. A liability has to be recognized even though the entity does not owe anything. That is counterintuitive, right? But it's brilliant. The framework cares about economic control, not just legal ownership. You can control a resource and therefore have an asset without actually owning it.
So, why does this matter? What's the big takeaway here? Well, these incredibly strict definitions are the standard setter's ultimate weapon against off-balance sheet financing. Historically, companies would use complex lease agreements to essentially borrow equipment or property without technically owning it or owing a traditional debt. That kept massive liabilities off their books so they looked financially healthier. By focusing on control and unavoidable obligations, the framework forces companies to accurately reflect real-world economic reality, completely bypassing those legal loopholes. Once we have assets and liabilities locked down, the third element is just simple mathematics. Equity. It's the residual interest in the assets of the entity after deducting all its liabilities. This is the core mathematical truth that balances the entire framework. Assets equals equity plus liabilities. It's the ultimate remainder.
The fourth element is income. The framework defines this as increases in assets or decreases in liabilities that result in increases in equity. Crucially, this excludes any contributions made directly by the owners, like issuing new shares. We're talking about a genuine enhancement of economic benefits during the accounting period through actual performance. And finally, the fifth element, expenses. These are simply decreases in assets or increases in liabilities that result in decreases in equity. Again, this excludes distributions to owners like paying dividends. And with that, we've got our complete set of building materials. Let's move to Section 4, presenting the financials, and see how this all builds together.
We have our standard setters, our golden rules, and our building materials. Now we follow IAS 1 to assemble the finished house. A framework-compliant, complete set of financial statements must systematically include these 5 documents: a statement of financial position, a statement of profit or loss and other comprehensive income, a statement of changes in equity, a statement of cash flows, and absolutely crucially, the explanatory notes to provide real context to all those numbers.
Tying it all together, IAS 1 mandates fundamental presentation principles. We see our old friend, the going concern assumption, return here. But it also mandates consistency in presentation from period to period and the strict use of the accrual basis of accounting. That means we recognize transactions when they actually occur, not just when cash changes hands. These principles ensure that our finished financial house is stable, comparable, and totally transparent for anyone walking through its doors.
Which leaves us with this final thought. The IFRS conceptual framework is an incredibly robust architectural blueprint. But as global commerce rapidly evolves into an economy driven by intangible data, complex crypto assets, and decentralized networks, you have to wonder, how will these rigid fundamental principles adapt to measure the highly complex digital businesses of tomorrow? Will our traditional definitions of assets and control hold up in a Web3 world? It's a fascinating challenge for standard setters, and definitely something for all of us to keep our eyes on. Thank you so much for joining me on this explainer, and keep questioning the framework.